Hey everyone, it's James from Mayflower Accountancy with our first video today to launch our YouTube channel, and I thought what a better time to start than looking at questions on Wednesday. I want to give you 3 quick tips that could save a little bit of income tax possibly for you if you get these in place by the 5th of April. So tax season's finished, the 31st of January has come and gone, but we still have 2 months until the end of the next tax year, the 2021 tax year, to maybe do a little bit of planning just to avoid some unnecessary tax being paid. What I have are maybe 3 things that could maybe help you save a little bit of tax. The first concerns high income taxpayers, those that are earning over £100,000 to £125,000 a year. And the second and third points are more for owner managed businesses, shareholders that have a company and a payroll, and some ways you could maybe make the most of those if you haven't done so already before the end of the tax year. The effective 60% tax rate is a quirk in the UK tax system, where individuals earning over £100,000 a year up to £125,000 a year are effectively paying 60% tax. What's happening here is that for every £2 you earn in income over £100,000, you're losing £1 of your personal allowance. What this means in practice is your higher rate starts sooner than £50,000, which it normally would if you were a normal taxpayer, and actually goes right down to £37,500. This effectively means that every pound that's being lost from your personal allowance is costing you 40%. Bearing in mind, of course, that because it's for every £2 that you earn, it's effectively half that, so we say 20% additional tax. Add on top the 40% tax you're already paying on that additional money, and that's where you get your effective 60% tax rate. Check my blog for an example as to how that looks, because it's quite tricky to understand. But what can you do to avoid it? Well, there are 2 really quick things that you can do. The first is look at your pension. You can make a quick top up, a one-off contribution, and get your taxes down. Do speak to a financial advisor about advice for that, but it's a great way of saving tax and also putting towards your retirement. Another thing you can do is make a donation to a gift aid charity. This will extend your basic rate allowance, and this has a nice win-win effect as well. Not only are you donating to a nice cause, but you're also going to be saving on that 60% effective tax rate as well. If you're in employment, you might be able to also trade that income for other benefits that aren't taxable, and again reduce your allowance that way, but it depends very much on the employer you're with and what benefits they offer. One final thing as well is if you're an owner managed business, a director and shareholder, then you might have a few more tools at your disposal to try and get that tax down. Again, that's all about planning with your accountant. So if you're a director of an owner managed business that you're a shareholder of as well, one of the challenges is how are you going to get that money out of that business to pay yourself personally? It's not as straightforward as being a sole trader where anything you earn is yours, but it's also taxed straight away. You do get a bit of flexibility on the tax side, but also you have to do a few more things to get that cash out of the business and into your own pocket. One of the ways you can do that is through paying yourself a salary, and depending on the salary you pay, depends on how efficient it could be from a tax perspective. The first number I want to talk about is £520, and the significance of this is what's called the lower earnings limit. What this means is you still don't pay any national insurance at all, you're not paying any kind of tax, but it's the lowest you can earn and still make qualifying years towards your state pension. Really, really important. If you can pay yourself anything this year, pay yourself at least £520 a month, because you're going to get those qualifying months, those qualifying years, and build up towards that state pension. If you pay yourself less than that, you're not going to be getting those tickets, those tokens towards that state pension. So please try and get at least £520 a month out of your company. Beyond that, the next number is £732 a month, and the significance of this is the other end of the low earnings limit up until what's called the secondary threshold. At this point you start to pay employers' national insurance, that's 13.8%. It's worth noting though that any employer's national insurance you're paying is actually an expense that's deductible for tax purposes, so you're going to save a little bit of corporation tax on that as well. So the effective tax isn't actually too bad, it's a little bit less than 13.8%. The next salary a little bit higher up is going up to what's called the primary threshold now, and that's £792. And at that point on you start to pay employees' national insurance, and that's 12%. However, that's not an expense of the company, that's an expense of the individual. So what's happening is your gross pay is being reduced by your employees' national insurance, so not as good from a tax perspective. The final salary I'd like to talk about is just under £1,050, actually it's £1,041.67, and that's basically 1/12 of your annual allowance, your £12,500 annual allowance. Here you're still paying full employees and employers' national insurance, but it's the last amount that you can earn before you start paying income tax at 20%. So Probably at this point on, the effects of having a salary in a limited company start to water down as you're getting more into sort of general PAYE. So what's best then? Well, it depends. If you're just a one-person band, it's just yourself and your company, you'll probably want to go up to that secondary threshold, that's £732 a month. But if you have 2 or more people earning that salary, then you can actually go a bit further, £792 a month. And the reason being is because you'll get an employment allowance. That's a £4,000 allowance that employers will get to cover their national insurance. Just means they can save a little bit of extra tax. So you might as well make the most of that secondary threshold and go right up to the primary threshold before you start paying employees national insurance. But as I say, personal circumstances, any other income you earn, what your business needs, what you want to reinvest and so on, can change that dynamic completely. So it is one of these things where having a good chat with an accountant may give you a different number than what I've given you today. Again, if you have that own and managed business and you're a shareholder, have you taken a dividend out of your company yet? Are you intending to do so? Well, there's a £2,000 tax-free allowance, a 0% allowance on dividends. That means you can take £2,000 regardless of how much other income you've earned and get that tax-free. It's one of these things where if you don't do it, you're leaving money on the table. The only thing I would say is if you've got a circumstance like before where you maybe have a lot of other cash coming in, a lot of other income, say you're in that £100,000 bracket, that £2,000 dividend will go against your objective of trying to keep out of that £100,000 limit. So again, it is circumstantial. Remember, that's £2,000 per shareholder as well. If you have dividends with other companies, if you have shares, for example, in other companies that are paid out a dividend, then that's also coming against your £2,000 nil allowance. Well, that's the first video done. It's been really good fun recording it. Hopefully you found it useful. I hope these will get more frequent and more polished as well as I get used to this. If you have any queries about what I've covered, or if you want me to talk about anything else, feel free to write to me at info@mayfloweraccountancy.co.uk. Email in the description or leave a comment. I'll try and get back to you. Do like and subscribe, and hopefully I'll have some more tips for you very soon. Have a good day.